Hi guys, let's get into the introduction to Forex and let's understand what Forex trading is all about. Now, Forex trading implies trading foreign exchange, which means currencies. So when we talk about Forex trading, we are referring to trading different currency pairs. Not the stocks, not the commodities, only currency pairs. Now let's take an example to understand how Forex trading actually works. Alright, imagine that you have an extra 70,000 rupees and you are expecting the price of US dollars to appreciate. Now you go to a money changer and buy US dollars worth 70,000 rupees. Assuming the exchange rate to be 70 rupees per dollar, how many dollars will you get? If you said $1,000, you are right. Now let's say a few months have passed and the exchange rate of dollar is now 72 rupees per dollar. Now if you return the $1,000 to the money changer, do you make a profit or loss, and how much? It's very easy to guess. You make a profit of 2,000 rupees with this transaction. Right? Now this is exactly how Forex trading works, with the difference that the quantity of currency which is bought or sold in any transaction is measured in terms of a lot size. Alright, so one lot in Forex trading is always equal to 100,000 US dollars. So if we were to buy one lot of euros, we would be buying $100,000 worth of euros. Meaning that at an exchange rate of 70 rupees per dollar, we are buying euros worth 70 rupees multiplied by 100,000, which is equal to 70 lakh rupees. 70 lakh rupees worth of euros. Now Forex trading is always done in multiples or fractions of one lot, which is known as the contract size, that equals 100,000 US dollars. Now let us understand what a pip is. So if we buy one lot of euros against the dollar, expecting euro to get stronger at a price of 1.1291, and the price moves up to 1.1292, this movement of the fourth place of the decimal is known as 1 pip. With a volume of one lot and a movement of 1 pip in our favor, we make a profit of $10. To understand this, we simply multiply the contract size of $100,000 into 0.0001, which gives us $10. So 1 pip movement gives us a profit or loss of $10 on one lot of Euro USD. Now let's see what the market hierarchy is. Alright, so in the Forex market, you have the retail traders right at the bottom and the major banks right at the top. What this means is that there is an interbank network between the retail traders and the major banks, passing through prime brokers, medium-sized and small banks, retail market makers, hedge funds, commercial companies. Now everyone is interconnected through the interbank network, which is basically the price feed. Alright, currencies are always being bought and sold, but right at the top is the major banks, the central banks, then are the prime brokers. So central banks provide the fees to the prime broker, the price feed. This goes to medium-sized small banks through the prime brokers, and this is passed on to the retail market makers, hedge funds, commercial companies. From there is the retail traders. Alright, so this is the hierarchy of the Forex market. Whenever you are trying to punch in an order, this is a chain that is being used. So anybody throughout this chain can be buying or selling currencies from you. Right? Now this is an OTC market, so there is no single exchange which is regulating all the transaction. It's an OTC market. All the banks and brokers are connected through a network. Now this makes Forex makes Forex the largest market to trade in the world. As you can see, the size of the equities market, this equity market is the we have combined all the equity markets in the world, the global equities market volume, in comparison to the Forex market volume. So the Forex market is 25 times bigger than the global equity markets combined. Right now you can understand the size in comparison with all the other stock markets of the Forex market. In terms of the transaction being done, as per the reports of 2018, we have a daily transaction of more than $5 trillion per day in the Forex market. Now this makes the Forex market a highly liquid market, which means that whenever you are trying to punch in a trade, you always get filled at the nearest price or at almost the same price as the one that you need, except the spread. So the broker ensures that the trade at which you want to buy will be given to you just as you at the click of a mouse. Now you can see that since the entire world is trading this market, this is a 24-hour market, so it is open 24 hours except on Saturdays and Sundays. So it's a 24/5 market. Trading begins each day with Sydney markets. As Sydney Australian markets open, then Singapore markets come in, traders from Hong Kong join in, moving to Tokyo, and then we have London markets opening, then we have the New York markets opening, and by the time the New York market closes, we have the Sydney markets opening again. So what happens is, because of this continuous trading from different parts of the world, we always have buyers and sellers, and we always have movement in the market. Now whether it is 2 a.m. or it is 2 p.m., you can always find a trading opportunity in this market. Right, now let's understand what a lot size is and how does leverage work. We saw that one lot is equal to $100,000, and we also saw how 1 pip movement is equal to $10 per pip. Now this movement of $10 per pip is in general, for some currencies it would be $12 per pip, for some currencies it would be $7 per pip. You have a lot of online calculators to tell you how to calculate the value of a pip, but in general it is approximately $10 per pip for most of the currency pairs. So when you're trading with a volume of one lot, you are actually buying currency worth $100,000, and 1 pip movement will give you a profit or loss of $10. When you're trading with a volume of 0.1 lot, this is called a mini lot. In this case, you are trading with a volume of $10,000, and 1 pip movement will give you a profit or a loss of $1. The last one is a micro lot, which means you're trading with a volume of 0.01, and that is equal to buying currency worth $1,000. A movement per pip would give you $0.1 or 10 cents. This is important to know so that when you are taking a trade, either on your demo or your live account, you know how much you are going to make or lose on your position. Now, as such, a lot of people feel that if a lot size is $100,000, it might be very expensive to trade, actually putting in $100,000. So Forex market works on the concept of leverage, where brokers provide you leverage ranging from 1:10 to 1:1000. Let's take an example of a leverage of 1:100, which means that if you want to buy one lot worth of currencies, $100,000 worth of currencies, we will be using a leverage of 100, which means we require $1,000 to be able to take a trade which is worth $100,000. Alright, so when we say leverage of 1:100, that means we divide 100,000 by 100, which is 1,000. Alright, so $1,000 times 100 is what the broker is offering us. Alright, so the broker says we just need to put $1,000 and multiply by 100 is the amount of currency that we can purchase for our trade. That's the advantage of the Forex market. Now, obviously, this could lead to a lot of profits or a lot of losses, which is why we have to maintain our risk using the volumes. But in general, this facility is why Forex market is so attractive, why so many traders are interested in trading in this market. And when you look at a trade, whenever we take a trade, now even if you were to travel outside India, or if you were to purchase currencies, you would not be able to purchase the currency at exactly the price which is being offered by the banks. There is always a difference. If you're buying a currency, you will get it at a price which is higher than the quoted price of the central banks. And when you are trying to sell a currency, you will get it at a lower price than the quoted price of the central banks. Now, this difference between the buying and the selling price is known as a spread. As you can see in this example, for this trade, we can sell our position at the price of 1.1288, and we can buy at the price of 1.1290. So there's a difference of 2 pips in this trade. This 2 pip difference is called the spread. This is the difference between the buying price and the selling price, or the ask price and the bid price. And this spread is what feeds the entire Forex hierarchy. So if we were to go back to the hierarchy, right from the major banks up till the retail traders, by the time a retail trader would buy a currency, and the currency would pass hands between all the levels. So at each level, there is a certain spread which is being taken off. Right, so that's how the spread works. Everybody gets paid from the spread, and the retail trader makes money from his profit or loss. Right, that's it for now. Stay tuned for more videos about basic concepts about the Forex market. For understanding technicals and further strategies, you can log on to our website and look at the strategies that we are teaching. Thank you.